Getting back to the budget figures themselves, though, I'm joined by economist Stephen Koukoulas. Thanks very much for joining me this afternoon. You've had a bit of a look at this final budget outcome document. What do you think? Is it good news, the better bottom line?
The better bottom line's always a headline grabber. It's nice that the budget's in a sound shape and a tiny deficit.
Would you call it balanced?
It's balanced. It's balanced. It's around here. In terms of percent of GDP, it's 0.0%.
So it's pretty close to a balance, yeah.
So that's it. It's been achieved, as you just mentioned, through the NDIS underspend and a bit of a windfall gain on company tax receipts. That iron ore price, the LNG exports coming on stream, and even coal exports remaining quite strong in volume and recently anyway in price terms.
There's also income tax are up, more people are in work, and that's contributed here too.
And it's offset the weakness in wages. So there's many moving parts in the budget. And at this juncture, unlike poor old Wayne Swan, poor old Joe Hockey in his early budgets when he was Treasurer, they've all come in the right direction for Mr Frydenberg. So that's why he had a bit of a cheeky grin today, because he's got that better budget bottom line.
Yep.
And with even average luck, the 2019-20 $7 billion surplus looks to be pretty much locked in.
Yeah, well, and I'll come to that, what happens from here. But another thing we see confirmed really in these final figures for last year is that people aren't spending a lot, are they? Because while company tax receipts are up, income tax receipts are up, GST receipts are down, and quite a bit.
And that's the missing link in this whole economy. If we think of what the Reserve Bank's been doing over the last couple of years, and some of the debate that we're seeing from the big corporate retailers, that they're doing poorly at the moment, that we consumers are not spending. And it's a combination of caution, the unemployment rate's creeping up a little, but it's partly a function of very weak wages growth and very high levels of household debt. You put that all together and think that the average Australian consumer's not getting much of a wage increase. They've got a very big mortgage. House prices were falling until very recently. It's not the sort of dynamics that's going to make people go out and rush and spend. So you're getting that weakness in spending, which is leading to the lower GST receipts for the federal government. So it's that missing link that's been identified by the RBA and now in this document of the weak part of the economy.
And we should point out the loser when it comes to GST receipts being down to the states, because
yes,
they're the ones who get that money. So anyway, less for all the hospitals and bridges and roads. But today we also saw some unemployment figures, which saw the unemployment rate tick up in August to 5.3%. So it's not a big increase, but it's going the wrong direction here, isn't it? Even at a time, August, when those tax cuts were hitting people's pockets.
And it's creeping up about 0.1 every 2 months. That's sort of been the average since the start of the year. We got to 4.9% unemployment rate. I think it was February, if my memory is correct. Yeah. And so it's just crept up, that 0.1 every couple of months. And even as worryingly is the underemployment rates also gone from about 8% to 8.6%. So people who have a job but want to work more hours, they're being told by their bosses, sorry, we can't give you more hours because my business just isn't strong enough to validate me hiring or giving you more hours. So we've got this weakness in the labour market despite the headline jobs numbers being good. 30,000 again, the second consecutive month, 100,000 jobs in the last 3 months.
Yep.
300,000 over the past year or thereabouts. They're good numbers, but the population growth is so strong, the participation rate's going up, that we're not making any inroads into unemployment.
Well, this then raises the question, is now the time for the government, given it's sitting on a bit more dough, to inject some of that into the economy to get things moving a bit more?
The short answer is yes. The market's now pricing in more rate cuts from the RBA, so they're going to be doing their share of the heavy lifting to try to get the economy going. But of course, that's only one lever that's being pulled on in the right direction at the moment. So I think as the government moves towards MyEFO in a couple of months' time, that's the opportunity anyway for them to use that as a mini budget, if you like, to not just give an update on the numbers. Here's the new surplus number, $6 or $7 or $8 billion, whatever it may be, but to actually have some policy initiatives.
Just on what that number might be, can I just ask you, because the figure we saw today for last year's budget was roughly $4 billion better than, or nearly $4 billion better than they forecast in April. Does that necessarily mean that the current year is going to be a better figure than the $7 billion surplus?
It normally does, yes. The short answer is yes, because that take-up of the low take-up of the NDIS probably isn't all of a sudden going to be met this financial year. the iron ore price, here we are in the middle of September, we know that it's still close to $100 a tonne versus a budget estimate of 55. So it's almost double. That's giving them many billions of dollars per annum. And while there's weakness in wages and weakness in spending, my back of the envelope calculation, updated with today's numbers, suggests that they've probably got more than the $7 billion for 2019-20 financial year. So they've got more room to move.
There's a bit of room to move. Look, no signs from the Treasurer today, though, that they're about to boost New Start, spend a hell of a lot more on infrastructure than they already planned to, or any of these things. But you expect come MyEFO at the end of the year, that's when we might see something.
I think I'd like to think that. And certainly the economics community, the business economists, market economists and others are saying, well, come on, the surplus is all good and well, and you don't have to blow it all. If we're assuming the surplus will be between 7 and 10, why don't you allocate 4 or 5 billion towards extra stimulus into the economy? Now, $5 billion isn't a huge amount. It's only, again, about 0.15% of GDP. But if you're looking to grow the economy at 2.5 to 2.6 to 2.7 to 2.8, every little bit helps.